Alright, this video is going to go into some analysis of the S&P 500 and show some data that I haven't shown before on the blog, and also talk about some general concepts regarding why we might be at a very important point right now. And the conclusion is really going to be that I think we're in for a very significant decline. Even if we consider this to be a new bull market, which I don't, there still should be a pretty significant decline coming. So what I want to talk about with this chart is why the level right now is so important. And I'm showing some pink lines here. Those pink lines are drawn across some key highs of bear market rallies towards the end of this bear market. And it's important to understand that if someone is trading this market and they are short on the S&P 500, say someone got short in the S&P 500 back here, and a market goes down, market breaks new lows here. Uh, a lot of short positions for long-term long-term holders, they're going to put their stops above the peak before that breakdown. And then again, you get a bear market rally and you get a breakdown to new lows again. Those shorts are going to end up having their stops at some of these levels above the major legs up or major bear market rallies. And the idea here is that as a market rallies, in this case, if we consider this a bear market rally, there's a likely to be a whole lot of orders that the market makers, we'll just say the market wants to fill, that need to fill above these prior important highs. And kind of going through the chart of what I've done on the blog is I had suggested a long trade on the blog right down here at the bottom on the Nasdaq, and got out of that trade somewhere up in here. Went short up in this area, made a profit, ended up trying to get short about 3 times in this area right here. And the reason I was so insistent on trying to do that is because of this very thing I'm talking about. There's this important resistance level, and the market tested it and closed below it, and it seemed to kind of chop around without being able to break out. Most of those ended up getting stopped out for break even or losses, and then finally there was a breakout of that level. Ended up going long somewhere in this level after the breakout, getting out at a profit up in these levels. And so now what we're doing is we've came back down, tested that breakout point, and we've moved up to the next main resistance level, which should be a very, very important one. The market has 3 days sent highs up above that level, and on none of those days has really managed to close above that high. And you can pretty much bet there's going to be a number of stops on short positions being run here. And the question is the market going to see a consolidation and then a surge in buying interest to push it above that level, or is it going to clean out all those stops on the short positions and then kind of fall apart? And that's really what I'll be looking for next week as to what happens. My opinion, I think most likely, based off of some other analysis of the US dollar, of commodities, and those type of things, I kind of favor that the market is going to break down sooner rather than later. But as a secondary case, if it would happen to break above these highs, there could be a quick move from this 950 up to the next main resistance level at about 1000 there. The next thing I wanted to talk about are some things related to real money indicators of what people are doing. Fund as far as putting money into funds, RIDEX funds, and then also look at some survey type data and to gauge the opinion of the investment crowd. Alright, this chart is from sentimenttrader.com again, and this is showing a ratio of the amount of funds in from the RIDEX family of funds, of bull market funds to bear market funds. So funds that will increase as the market rises versus funds that will increase that are negatively correlated to the market and will increase as it falls. And this up here is showing the amount of funds in bull assets, and this is showing the amount of funds in bear assets. And down here, this is showing some standard deviation bands with a ratio of those two. And what we can see is just in the last week or so, this ratio has reached levels corresponding to the highest the ratio has reached for the last decade, really. And those highs of bull market funds were right at the top of near the top of the bull market in 2007, and then right at the highs in 2004 before a couple of significant corrections, and the market basically went sideways for the entire year of 2004. So we're seeing that this real money gauge of how RideX traders are behaving is that they're excessively bullish to a historic extreme here. So that's going to give us a warning that we want to bet against those traders, that it's gone too far one way. Now I'm going to show a similar chart, except this is rather than just bull divided by bear assets, it's leveraged ones. So it's funds that move either typically 1.5 or 2 times the beta of the market itself. So a leveraged bull fund might be if the S&P goes up 1%, it'll go up 2%, and then the leveraged bear fund would go down 2% if the S&P went up 1%. So this chart's showing the same thing: the leveraged bull assets, the leveraged bear assets, and then it's showing the ratio down here, and we're seeing again that ratio. The bull ratio just spiked up to the highest level it's been since the last bear market, and again those highs were right at near the peaks of the bull market, and also in late 2004. So these two charts are showing somewhat the same thing, but this chart's interesting in that people are actually more extremely leveraged bullish, willing to buy into these higher risk funds more so than at any time in the past on this chart, really about 8 years. And this is going to be the last chart I'm going to show for today, because I frequently cover the S&P in regular blog updates, but this is something I haven't shown before, and I wanted to wait until the weekend data came out for this because I thought I knew about what was going to happen with it, but I wanted to make sure. This is a model from sentimenttrader.com, and it's called the Advisor and Investor Model, and it combines the 4 main surveys, investment newsletter survey type things, and public surveys into one model down here, and shows you whether as a whole there's a lot of bullish opinion or bearish opinion. And the best way to use this is the red dotted line up here is like the 200-day moving average of the S&P, and you want to use signals that are counter to that larger trend to either buy or sell. So if the market's in a bull market and the 200-day moving average is rising, you want to buy on these real bearish opinion dips. And if the market is falling, 200-day moving average is declining, you want to sell on these really bullish extremes in the data. And what's important here is, since the peak of the bull market in 2007, we haven't seen this composite model of these surveys get to a bullish extreme. But as of last week, they did get up to this extreme level. That would, and this is with the 200-day moving average pointing down, so that should give us a great deal of caution, because this model tends to be a good long-term signal, in that several months down the road you're going to see lower prices for several months in this case. And if you look back at this area of the chart, the tech bear market, after the peak of the bull market, there was 2 times that this model was actually able to get to a bullish extreme. Both of those times the market was topping out and led to some severe declines. I would say, from my opinion, that where we are right now is similar to this level in that bear market. We've had a very strong rally, actually bigger than the other bear market rallies, but I think it's going to end up being not a bear market low, but a pretty big bull trap, and see new bear market lows. So this is just something to be aware of. This tends to be a long-term signal. So at the minimum, as I had said in some previous posts, I would expect a significant retest of those lows, maybe 3/4 of this rally given back before possibly a new bull market would start. But again, I think, from my opinion, from price patterns and everything, that this will probably end up leading to new bear market lows sometime later this year.